Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Global stocks rally with U.S. equities hitting another high. Traders are still pricing in 2 Fed cuts this year after Powell's comments about a cooling job market. Don't wait. Vlodymyr Zelenskiy urges NATO allies to help his country now before the U.S. election. The Ukrainian president wants backing to hit targets deeper inside Russia. Plus, Moody's downgrades Kenya deeper into junk after deadly protests forced the government to scrap a plan to hike taxes. We're live in Nairobi with the details. Well, it's just gone 8 a.m. across the Emirates, 5 a.m. in the UK. I'm Jumana Versace in London this week. A check on markets and how we reacted to that long-awaited Powell testimony yesterday. You can see towards the close yesterday, small inching higher of the S&P. Today, the futures are also slightly higher, about 6 basis points or so, but another record high. So even though it's not big moves that we're talking about here, the S&P continues to go from strength to strength. 10-year yield sitting at around 4.30, slight movement upwards. We're going to talk about the contents of what Powell discussed, but essentially a lot of focus on the slightly weaker labor market in addition to the ongoing disinflationary process. No surprise there. Brent is slightly softer this morning, below $85. We're dipping about 0.25%. This as the market digests the impact of an earlier than expected hurricane season, with Hurricane Beryl starting things off a couple of months earlier than would be seasonally expected. Despite that, no sustained outages, which is why Brent is coming off a little bit. And then iron ore, we don't talk about it a lot, but as you can see from the price action this morning, it is down 2.3%, slumping. Iron ore futures are down about 23% this year. Typically, you get a bit of support around $100, so we'll see whether that support does come in this time around. Our terminal chart today, this is one I want to draw your attention to, and I kind of alluded to it at the top of the show. Despite the fact that data has started to disappoint to the downside and some of these economic surprise indices indicating that there is weakness in the underlying economy, what are we seeing in stock markets? They keep going up. So just a reminder, stock markets are not a reflection of the real economy and what is happening right now with U.S. data. All right, let's also get a quick check on markets with Avril Hong in Singapore. And Avril, what is the instant reaction you're seeing to these Powell comments from yesterday?
Yeah, Jumana, really interesting how he didn't let on very much in terms of the timeline of rate cuts, right? But to some, the risk to the labor market that he flagged might be seen as a bit dovish. But given how the comments came in, it's perhaps unsurprising that it's a mixed bag in Asia stocks. Interesting to see how the Chinese gauges are clocking slight gains despite a CPI print that came in today that was lower than expected, and just showing the deflationary pressures in the country persist, maybe raising some hopes of the PBOC rate cuts come September. But the RBNZ is something that we've been focusing on as well today. It came in more dovish than expected. And we've been seeing this really crowded trade in long Kiwi positions ahead of the decision. That's certainly something that markets were not priced for. So the Kiwi is losing ground today, the most in the Asia Pacific, and against every other currency. We're seeing the climb in bonds as well as stocks in the country as well. Jumana.
Avril, thank you so much for the overview. Now, back to that main story. Fed Chair Jerome Powell says officials are increasingly wary of potential risks to the labor market from high borrowing costs as they seek more evidence inflation is slowing down. Speaking before the U.S. Senate Banking Committee, Powell was careful not to offer a timeline for interest rate cuts, which investors are now betting will begin in September.
I'm today not going to be sending any signals about the timing of any future actions. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be in, as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Okay, let's talk more about this. We have news desk editor Jill Ditas joining us now. Jill, what were your main takeaways from Powell's comments? I mean, he's talked a lot about some of the softening we're seeing in the labor market. How does that translate to, perhaps some clues about how they're thinking about the trajectory of the economy from here?
Yes, Jemana, it does seem like the key takeaway here is that the Fed is probably getting ready to cut rates. I mean, look, Jerome Powell just said there, I mean, he doesn't want to give away any clues on when exactly that may come. That's very obvious there. But I think you do have to really look at those comments that he was saying about the labor market. I think he brought up the cooling labor market something like 5 times in the speech. Really kind of shows you there that the Fed is kind of taking under consideration its dual mandate and really placing an equal weight here, not just its concerns about price pressures, which is what we've been seeing obviously over the past couple of years, but it's also really starting to look at that unemployment issue as well. I mean, I think he pointed out that we've now seen 3 straight months of rising unemployment in the U.S. We are seeing a lot of those signs about the cooling labor market, and so that does seem like they're getting ready to position for a rate cut sometime in the future. Markets are betting September. Maybe that's actually going to be the case.
I thought it was pretty interesting that as of yet, there's been so much focus on the disinflationary path of inflation in the U.S. But recently, Powell seems to be talking a lot more about that softening in the labor market, has even suggested that if there is a very amplified softening, that would force them to act. So at this point, the markets are pricing in about 18 basis points into that September meeting. How likely is that rate cut looking?
Well, I think, Jemana, that we're going to have to see how the next few jobs reports shake out, whether that trend within, that rising unemployment that's tipping up continues to, unfurl. I think that Jerome Powell did kind of seem to say that, look, again, the last 3 months of that rising trend does seem to indicate something that they need to pay attention to. That, I think, was enough for markets, at least, to look at that September meeting as really that one where we're going to see likely that first rate cut of the year. We'll have to see again how much of this actually does play into the next few months. I mean, the Fed has long said they're very data dependent. They're really, really sensitive to how all of this stuff is unfolding. But the evidence for that cooling labor market does appear to be mounting there. Yeah.
Well, we'll have to keep a close eye, as market participants are. News desk editor Jill Desis. Now let's bring in Ryan Lemand, the CEO and co-founder of Neovision Wealth Management. Ryan, good morning to you. Always good to see you. Let's just start off talking about some of the comments that we got from Powell yesterday. A focus on the softening of the labor market. I was just discussing that with Jill. Did you learn anything new as a market participant? Did you walk away feeling more vindicated about your own call for further rate cuts this year, or the beginning of rate cuts this year?
Jumana, not really, because this started 1 month ago during the meeting that the Fed had, where Chair Powell has said that jobs are being overstated or overestimated. I forgot the exact word. That was very revealing that he bring this up. So last night saying what he said was absolutely not surprising. If you look at full-time jobs, they are dropping like a rock, despite payrolls going up, but full-time jobs are dropping. And this is really concerning. The U.S. typically, economically, things go slowly, and then very quickly. And I think this is exactly what Chair Powell wants to avoid.
And we've spoken about this in the past, and you think that perhaps the Fed are keeping rates too tight for too long. They're at the risk of not cutting quickly enough. To what extent do you think that is going to become more apparent we've spoken about the labor market, but in the inflation data? Because last week at Sintra, Powell suggested that they're not expecting to see inflation hit 2% in 2024.
Yes, absolutely. This will take time, clearly, because the last mile is always the most difficult with inflation. And this is where usually inflation, when it goes very close to 10% and then drops back again, usually we have a second cycle of inflation. So it's self-fulfilling. And this is what I think Chair Powell wants to avoid as well, which is a second cycle of inflation, as we have seen typically in the U.S. So today, that's why they're very careful. But at the same time, they do not want the jobs market to collapse, unemployment to spike up, because this is when we have a hard landing. And let's remember that this is precisely what the Fed wants to avoid. They want a soft landing and get as close as possible to 2%.
Yeah, not that markets seem to care. Our terminal chart today is quite demonstrative of the fact that S&P keeps climbing to record highs, despite the fact that some of the data has started to soften. I was looking at the numbers for the first half of the year. 60% of the performance of the S&P has been driven by the Magnificent Seven. Is that going to continue, Ryan, into the second half of this year?
Clearly, it's going to continue. The concern here, because it's mainly driven by AI, And all of the spending that is going into AI, we do not yet see a product that will bring that revenue to justify all of this spending. So if you look just ballpark figure, we will need roughly $600 billion of revenue to justify all of the spending going into GPUs and data centers. And at the moment, you have OpenAI, which is the biggest, and they're bringing $3.4 billion in revenue. So we don't yet see the product there. However, speculatively, yes, we expect it to continue as long as things are holding up as they are at the moment.
Well, we've got earnings season. It always comes around faster than you think it's coming, but it's starting again this week with the U.S. Wall Street banks. Is there anything you're watching out for that you think could impact the direction of travel for stock markets from here, given so much of it now is concentrated in the hands of Magnificent Seven?
Yeah, the concern for us are banks. So we do expect a shrinkage in revenue of 10% rather than growth. This is on the basis of net interest income reaching an inflection point and starting to drop. So banks have done very well with NIIs. However, now there's an inflection point and it's starting to drop. Second, loan growth has been quite sluggish, and understandably so, because credit conditions are quite tight. They haven't relaxed them, which is a very good thing. So we do expect banks to start making less money and even shrink in revenue. Let's hope we don't see any collapses in banks, specifically regional banks, because this, I think, can spoil the party for AI.
Well, we said the same about a year ago, and that didn't seem to spoil much of the party if you rewind back to those days when U.S. regional banks were looking a little precarious. Ryan, final quick one for you. I see still from your asset allocation that you're sitting at around 30% cash. Given your very strong views on the U.S. economy and the fact that the Fed will probably have to start this rate cutting cycle soon, are you thinking about increasing your cash holdings, perhaps as a defensive play into the end of the year?
For now, the cash position is bringing quite a bit of return, because they are mostly in fixed deposits, and we're earning 5 to 6% in these. And this is smoothing the portfolio volatility and giving us a bigger risk budget to allocate to risk assets elsewhere other than the US, namely India, China, Japan, and a few other countries. So for now, the cash position will remain stable.
Fair enough. Okay, Ryan, always good to see you. Ryan Lemand, CEO and co-founder of Neovision Wealth Management. Thank you. Still ahead, NATO leaders pledge historic support for Ukraine, but recent assessments suggest that Kyiv's conflict with Russia is headed towards a stalemate. The details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Bersachi in London. NATO has opened its summit in Washington by promising 5 long-range air defense systems for Ukraine in a fresh show of support. The move comes even as the alliance resists offering Ukraine a clear path towards a membership. Fresh assessments indicate the war with Russia is headed towards an indefinite stalemate, and Ukrainian President Vlodymyr Zelenskiy is urging NATO allies to help his country now and not wait for the U.S. elections.
It's time to step out of the shadows, to make strong decisions work, to act and not to wait for November or any other months to this end. We must be strong and uncompromising all together. And first of all, America.
Let's talk more about this with Bloomberg's East Asia government editor, John Herskovitz, who joins us now from Tokyo. Yesterday we spoke about the challenging backdrop going into this NATO summit, not least because so many of the leaders attending the summit have their own issues back home. So it is notable that they came to some form of extra commitments and support for Ukraine. What have been the main challenges, though?
The main challenges are making this go even further. And this is the 75th anniversary. It's designed to show the strength of the alliance, and in the face of challenges from Russia and from China. But as President Zelensky alluded to, there are things that are pressing and immediate. One thing is the U.S. presidential election. President Biden, who is, I think, 81, actually probably the only leader who's older than NATO itself, is facing a challenge from Donald Trump, former President Trump, who has shown his skepticism towards NATO, towards aid to Ukraine. And the clock is ticking in terms of Kyiv's perspective, and a lot of members also see this. Zelensky has been trying to get an invitation to membership that is not coming from this meeting, it looks like, but the aid is coming with these 5 long-range air defense systems which have been pledged. So we have that as the main thing, and also keeping the alliance viable going forward, especially with what's going on with elections in France, in Europe that have impacted Germany, and most importantly, the U.S. presidential election.
Though, of course, at this summit, they stopped short of what President Zelensky would like to see, which is a formal invitation to join NATO. So that's happening on one side. On the other side, we've been paying close attention to some of the visits that President Putin has paid to those Asian countries. And recently, the Prime Minister of India, Modi, paid a trip to Russia. So what does that say about the bloc's plans to isolate Russia?
I mean, the trip from Prime Minister Modi to Russia is a very good example of how difficult it is to contain and isolate Putin. I think that we may have a video and some comments from Modi when he's speaking with Putin.
India is ready to provide support for the restoration of peace. I was very happy to listen to our opinions on it. I assure you and the global community that India favors peace. After listening to my friend President Putin, I am hopeful for peace.
Good. And you see with that quote that Modi is speaking to 2 audiences at the same time. He's speaking to Putin, who he's addressed as his friend, and he's speaking to the global concerns. I mean, this visit came on the heels of an attack on a hospital in Kyiv, and it's a very difficult position for Modi to be in. On one hand, India is a buyer of Russian oil and weapons. Modi sees Russia and China, their alliance, getting stronger as he's having difficulties with Beijing. And at the same time, you have the U.S. and its partners trying to bring Modi in to help them in their security concerns as they try to contain what they see as China's aggression in places like the South China Sea. So it's a difficult balancing act for Modi. And this trip really shows it, and it shows the difficulty in isolating Putin, who recently visited North Korea to procure weapons, visited Vietnam, and is meeting with global leaders as NATO and its partners are trying to contain and isolate him.
Yeah, thank you for the overview. Bloomberg's East Asia government editor, John Herskovitz. Now for a look at some of the other stories we're following this morning. Bloomberg's been told that Saudi Arabia has privately hinted it might sell some European debt holdings if the G7 seizes almost $300 billion of frozen Russian assets. Sources say the finance ministry has told some G7 counterparts of its opposition to the idea, which is meant to support Ukraine. The kingdom's European debt holdings may amount to tens of billions of euros, but that may not be enough to move markets if sold off. But strong political statement nevertheless. Coming up next, Aramco is looking to raise a minimum $3 billion from its first bond sale in 3 years. More on that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Bersechi in London. Bloomberg understands that Saudi's Aramco is looking to sell bonds for the first time in 3 years. The oil giant is hoping to raise at least $3 billion so it can refinance debt and contribute to its investment program. Aramco is offering securities with a maturity of 10, 30, and 40 years. So for more, our senior reporter for Middle East Wealth Funds, Matthew Martin, joins us now from Riyadh. Good morning to you, Matt. What is Aramco looking to do with this cash, and why now?
Well, Aramco, I think, is coming out now. It's off the back of this secondary offering, which we talked about a lot last month when the government sold off a stake in Aramco, and Aramco went around the world really pitching this to investors and trying to gather interest. And it's come off the back of that with a lot of investor demand from foreign investors for the stock. And so it sees this now as an opportunity to come out and capture some of that interest, capture some of that demand that is generated for exposure to Aramco, and then also do something on the debt side. It's got quite a bit of debt coming up next year. It's got these huge investment plans that it's doing as it develops gas resources and looks to make acquisitions internationally as well. And obviously as well, this massive dividend of over $100 billion a year to pay for. So Aramco is not going to be short of options for things that it can find to use the money that it raises from this debt sale.
It seems like they're going for the dual approach of the both equity and bonds coming off that Aramco secondary offering, which went quite well. And at the time we spoke about healthy foreigner demand. How much investor demand is there expected to be for this bond sale? And what does that mean for ultimately how much they're looking to raise?
Yeah, I think what we've seen over the past when Aramco and when other parts of the Saudi government have come out is that they tend to yield pretty well for compared to other similarly rated entities. So that means that they normally do gather strong investor demand. So I wouldn't be surprised if we see, although what we hear from sources is that they're looking to raise at least $3 billion. I wouldn't be surprised if once you see the order book come in for this, that they look at upsizing that offering and look at maybe taking a little bit more, because as I say, they normally reward investors quite richly when they come out and price these deals. So they normally do gather quite a bit of investor demand for them.
Well, look, I mean, it seems to be a positive picture in terms of demand, as you flagged, with the secondary offering, with this new potential bond sale. But yet, we hear about, potential further funding issues to come, the fact that Saudi may have increasing amount of needs over the next couple of years to finance some of their spending plans. Is there any signs that investor appetite may start to wane?
Yeah, I think that's going to be the big thing to watch out for over the coming couple of years, because we've seen already so far this year Saudi Arabia and sort of the wider Saudi Inc., all of the government-related corporates, the biggest borrowers out there in emerging markets. So they're topping even China so far this year, raising well over $30 billion. And so although, Saudi debt has been coming from a low base, and just about 10 years ago, there was hardly any Saudi debt. Now the pace of that is expanding really, really rapidly. And so we're going to have to watch, and the Saudis are going to have to watch really carefully how that demand picture goes, and if it's still there in a few years' time, if they keep borrowing at the pace they're at now. Yeah,
very clear. Matthew, thank you for bringing us that story. Senior reporter for Middle East Wealth Funds, Matthew Martin. Also coming up, investors are pouring into Bitcoin ETFs after their cryptocurrency tumbles around 20% since early June. We have the details and more coming up next. This is Bloomberg. This is Horizon's Middle East and Africa, our top stories this morning. Global stocks rally with U.S. equities hitting another high. Traders are still pricing in 2 Fed rate cuts this year after Powell's comments about a cooling job market. Don't wait. Vlodymyr Zelenskiy urges NATO allies to help his country now before the U.S. election. The Ukrainian president wants backing to hit targets deeper inside Russia. Plus, Moody's downgrades Kenya deeper into junk after deadly protests forced the government to scrap a plan to hike taxes. We're live in Nairobi with the details. It's just gone 8:30 a.m. across the Emirates, 5:30 a.m. in the UK. I'm Giovanna Versace in London. All of this week, a check on markets. S&P ended slightly up in the green yesterday. Yet another record high for the U.S. major. Today, futures are indicated in the green as well, moderately so. And of course, the market is digesting those comments that came out of Powell. A lot of discussion around the state of the U.S. economy, particularly the cooling of the labor market and what that means for the potential for the Fed to actually start that rate cutting cycle cycle. About 2 rate cuts are priced in for this year, about 18 basis points priced in for September. 10-year yield sitting at 4.3%. We had a moderate move higher in yield terms, about 1 to 2 basis points after the or during the course of the Powell testimony. So not a lot of movement, but we did see a strong 3-year auction, and so the curve steepens up a tad. Brent is sitting at $84.50 here, so slightly softer as Hurricane Beryl seemed to have passed without a lingering impact on production levels, but it did actually indicate that the hurricane season in the U.S. has started sooner than what would be typically anticipated. So something to watch out for as we head into the seasonals. And then iron ore also in focus today. You can see it is dropping around 2.3%. It is down about 20% this year. Typically, you get some support about $100. So let's see whether or not that comes in. Our terminal chart for today, we've been talking about the divergence between some of the price action we're witnessing in stock markets, S&P, another record high, and the disappointing data that we've got out of the U.S. as of late. And you can see that demonstrated via this Bloomberg Economic Surprise Index, which has been dropping over the course of the last couple of weeks. So even though the data is softening, what we are seeing is that the valuations and S&P 500 pricing is still holding up. And a quick check on markets in Asia with Avril Hong, who's standing by in Singapore. Avril, how has the reaction been to some of Powell's comments yesterday?
Yeah, Powell's comments are inspiring a bit of a mixed reaction this part of the world, but I also wanted to highlight what we're seeing among some of the Asia-Pacific central banks. We heard from the RBNZ today coming in dovish, and that is leading to these losses you're seeing on the Kiwi, on Aussie Kiwi. Traders are actually adding to long positions, so we hear, and this is amid the divergence growing between the RBNZ and the RBA. Of course, when it comes to the BOJ, we are watching for what institutional investors have to say. They're being consulted yesterday and today as to the BOJ's bond reduction purchase plan. And so far, they have been calling for pretty hefty reductions. So that's something else we're keeping an eye on. The bonds in China continuing their climb, and the yuan is slightly weaker, but flip the board as the PBOC has been raiding these bonds to sell to cool the rally. I thought I'd just highlight what some recent survey numbers and findings actually show that on the 10-year yield, the line in the sand to watch that traders think the PBOC might be inspired to step in is the 2.25%, and on the 30-year yield, 2.45%. Jumana.
Pretty remarkable rally that we're seeing in those Chinese bonds. Thank you, Avril Hong in Singapore. Well, we're going to talk about Bitcoin. It's been a while since we last checked in on Bitcoin, but as you can see, there has been quite a big decline in the price of Bitcoin over the course of the last month, down 15%, down about 20% since the highs we got to back in June of about $70,000. So a quite notable decline there. We are back at where we were back in February, and of course, a lot of mounting concerns that creditors of Mt. Gox will start to offload some of their tokens, which has been weighing on the market. But that is the picture for Bitcoin. But in the crypto space, I want to bring you some news out of the region. Indian crypto exchange CoinDCX has acquired Dubai-based trading platform BitOasis for an undisclosed figure. BitOasis has secured over $40 million in funding since it was established in 2016 and is looking to further its presence across the GCC and MENA regions. So let's bring in Ola Doudin, co-founder and CEO at BitOasis. Good morning to you, Ola. First of all, congratulations for the acquisition. Talk us through why it made sense.
Thanks, Jumana, for having me on the show. We're very excited about the acquisition and joining forces with CoinDCX. I do want to say this marks a great milestone for us at BitOasis. It marks a new journey focused on growth and even more so focused on our markets and our market leadership. Since day one, we've been the first platform that launched in the region. Today, this is the first of its kind acquisition deal in the region, marking a new level of maturity as well in this space. CoinDCX has made an investment in BitOasis back in 2023, so it's been almost a year since then. And since we've received the investment, our volumes have doubled in terms of average monthly volumes. We've recently secured 2 new licenses, and there were significant synergies, I would say, between us and CoinDCX. One focused on regulation, 2 hyper-focus on customer and our markets as well in terms of the localization aspect of it. So when we've realized the synergies, it made a ton of sense for us to align ourselves with a multi-billion-dollar group as CoinDCX, join forces with the wider company, and also have more resources and focus on our markets and our mission, from day one. I think from a CoinDCX perspective, obviously they liked BitOasis so much that they wanted to double down through an acquisition and not further investment. And I think it turned out a great outcome for us as well.
Yeah, Ola, and from what I understand, brand and leadership is going to stay in place for BitOasis. So what does the acquisition offer to you in terms of growth potential in the region? How is it going to unlock some of that potential?
So BitOasis will remain independent, will keep its brand, its leadership team. I'll continue leading BitOasis through our expansion and our markets and our mission in terms of providing a safe, regulated platform and further, I would say, spread adoption of crypto will remain as is. With us aligning ourselves with CoinDCX and being part of a larger multi-billion-dollar group, we'll be able to tap into more resources, more tech know-how, really expand our product offering, further diversify, I would say, as well, in terms of user bases that we will be serving. And I would say also more capital for us to be able to continue executing on our mission and have that bigger focus on our markets as well.
So, this is an Indian crypto exchange that acquired your company. And I wonder also what it tells us about how global markets are thinking about the crypto opportunity within the Middle East region. It is notable that, the acquirer came from another part of the world. What does that tell you about how they're thinking about the crypto opportunities within the Middle East region right now?
Yeah, great question. For us, I think when we look at crypto and we look at the Middle East market and specifically India, you actually have two significant crypto markets in terms of where they are right now and growth. So India today is the #1 crypto market in terms of size, and the Middle East over the last couple of years has been the fastest growing in terms of growth rates. And I think when you look at the synergies in the market, particularly when it comes to payments, remittances, and also the size of expat communities here in the UAE, there are clear synergies from a market opportunity perspective. And those are some of the things that we'd like to capitalize on as well over the coming years, with BitOasis being part of a larger India-based group.
To what extent do you think is volume and trading determined by price action in Bitcoin? Live and die by the sword. We're talking about a bit of a pullback in the price of Bitcoin over the last couple of months. Has that affected trading? Are you seeing more or less volumes given the pullback over the last few weeks?
Yeah, so obviously price in crypto, Bitcoin and other cryptos in the market is always volatile in the short term. Having said that, we're still seeing resilience in the market. Obviously with more volatility for us as a trading platform in the short term, we definitely see more volumes and hence more user activity. Ultimately that shows in more, I would say, platform activity amongst users, particularly traders. It's hard to sort of predict what the coming few months would look like in terms of price action on the crypto side. But as a business, I would say that we're definitely focused on the medium to long term and offering more products and more tokens for our investors to trade on.
Yeah, I guess my final question to you is whenever anyone talks about a Bitcoin or crypto world, one of the big themes that comes up is the launch of those ETFs. And I think there was a view out there that would bring in new demand from retail, potentially from institutions as well. Have you actually seen that new demand? Who is the marginal buyer of Bitcoin or cryptos at this point?
Yeah, so from a regional perspective, I would say particularly in the UAE, and I would say we've seen that trend over the last 12 months, more so from an interest perspective after the Bitcoin ETFs was launched earlier this year. An increased interest from high net worth individuals, family offices, or what we would call institutional user base. I think there are two reasons why that interest is growing in the region, particularly here in the UAE. One is the maturity of the regulatory frameworks. So with the introduction of the VARA, the Virtual Asset Regulatory Authority, the first crypto regulator, in the UAE here in the region, and I would say obviously more maturity in frameworks across, Abu Dhabi and Bahrain. So I think that is providing more confidence for this user segment to invest in this new asset class as crypto. And definitely with the Bitcoin introduction of Bitcoin ETF and seeing more institutional capital flowing into the space by way of introducing those products has increased that interest as well. I think we're obviously yet to see that capital mobilize in the region towards investing in crypto. But from BitOasis perspective, we've definitely started seeing that growing interest. And I would say also capital flowing from high net worth individuals into Bitcoin specifically.
Yeah, super interesting. Ola, thank you so much and congratulations again. Ola Doudin, the co-founder and CEO at BitOasis. Also coming up on our show, a report ranking the world's best and worst airports is out. We tell you which airports are flying high this year. Next, this is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in London. Moody's has cut its rating of Kenya's credit deeper into junk after deadly protests forced the government to scrap a plan to raise more than $2 billion in new taxes. The agency reduced Kenya's rating one level and maintained its negative outlook on the country's debt. Moody's says it doesn't expect the government to introduce significant revenue-raising measures in the foreseeable future, given heightened social tension. So for more on this, Bloomberg's Eric Ombach joins us from Nairobi. Eric, a couple of weeks back, we were talking about all the protests that were taking place and how they turned violent and what that meant for the government's plans. And clearly they had to backtrack given the scale of anger on the streets. But now they're faced with a downgrade. So what does this mean for the Kenyan economy?
All right. Thank you very much for having me. So the first thing to note is that ratings agencies have a rating scale. In the case of Kenya, as you mentioned, it was downgraded from B3. B3 basically means that the country had a high credit risk, although it is still able to meet its financial obligations. Now it's been downgraded to CAA1, which means that Kenya's debt affordability is seen remaining weaker for longer. Now, one of the consequences of that downgrade is increased cost of borrowing for the Kenyan government. So the country is now considered as a riskier borrower, and therefore bondholders in both domestic and foreign government debt will be seeking a premium whenever they lend money to the government. Already we saw yields, the yields to maturity for Kenya's Eurobonds maturing in 2031, 2032, and 2048, rising by a few basis points each yesterday. Coming to local debt, we have a treasury bill auction every Thursday, and week on week we've been seeing the yield curve rising. We also have a monthly treasury bonds auction, at least one bond auction every month. We had one last Wednesday. There's another one coming up next Wednesday, and it will be interesting to see whether investors will be demanding more for them to lend money to the government. Yeah.
When we were discussing the protests a couple of weeks back, we were talking about some of the fiscal challenges facing this government, and they tried these revenue-raising measures with no success, obviously. So how is the downgrade likely to affect the Ruto government's spending plans, given they can't raise revenue? Are they going to have to cut spending?
Yes, they are going to have cut spending, and already the president announced that initially the finance bill was expected to raise 346 billion shillings in additional taxes. That translates to about $2.7 billion. He said the government will now cut its budget by 177 billion shillings, which is about $1.28 billion. So already there is a spending cut. Some of the government programs will then be affected. The other thing is that that revenue shortfall will increase the budget deficit for the current fiscal year. Kenya's fiscal year begins on 1st July. So for the current fiscal year, that deficit as a percentage of the gross domestic product is going to increase to 4.6%. Initially, that was expected to be a deficit of 3.3%. The other thing is when the president spoke about the budget cuts last week, he also did announce that 47 state-owned enterprises are going to be dissolved. And he also announced that any civil servant who's reached the official retirement age of 60 will have to leave work immediately. So those are some of the immediate impacts that we've seen.
Excellent. Thank you so much for sharing with us the latest from Kenya. Bloomberg's Eric Ombach in Nairobi. Well, if you spend long hours waiting at airports, speaking about myself, maybe other people at Bloomberg as well, this next story is for you. A report released by AirHelp, a company that assists passengers get compensation from airlines, has ranked the world's best and worst airports. Taking the crown this year is Hamad International in Doha, ahead of Cape Town International in South Africa. Japan claimed third and fourth spots. But the real surprise this year is in the U.S., Salt Lake City cracking the top 10 with an overall score of 8.28 out of 10. So for more on this, Bloomberg's aviation and transportation reporter Danny Lee joins us from Hong Kong. Danny, what stands out to you in this ranking? I got to say, I was pretty surprised to see a U.S. airport on the list. Tell us how these airports are being judged.
Yeah, I mean, for Doha, first of all, with its beautiful terminal building, you've got great shopping experiences for food and beverage as well. You see that big bear as you pass through security, and even the relatively new orchard and the transit experience, all of that adds up to, unsurprisingly, Doha being one of the best airports ranked in the world. But what surprised me was the lack of other mega hubs in the list. Hong Kong, Singapore, even Dubai. So it just shows that how subjective these lists are. But when we round off the list, when you look at your region of the world, we do see the likes of Johannesburg making the list, Muscat as well. So some of these airports doing really well in the top 10 rankings. But when you look at what everyone is being judged at these airports, for AirHelp, when it does help passengers get compensation, the success of that, all of that kind of feeds into this ranking. Also the ratings on food and beverage, restaurants, and even punctuality at the airport. So there's a wide variety of metrics being used, and clearly some of these better-known airports are not making the list, and some of these smaller ones are flying high.
Yeah, flying high. Yeah, that's a good pun, Danny. Well, it's good to see that Horizon's Middle East and Africa airports are making it into the list in a substantial way. That was Bloomberg's aviation and transportation reporter, Danny Lee. Thank you. Also coming up, Samsung's largest labor union is calling for an indefinite strike. More next on what this means for the production at the world's largest memory chip maker. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in London today. A labor union representing thousands of striking Samsung electronics workers says it is prepared to extend the current walkout indefinitely. The move threatens to affect chip production as global demand for AI technology booms. So for more, let's bring in our tech reporter, Annabelle Drewlers. Just give us the latest on the strike. Why is it happening, and what sort of an impact it could have on production?
Yeah, so this was a strike. It actually started as a 3-day strike, Monday, Tuesday, Wednesday. But then earlier today, we actually got word from the union that they were planning to extend it indefinitely. Why exactly the union is saying this is because it basically relates to Samsung and the union's view that Samsung is not engaging with its demands. What they're asking for, where there's a few different things, but mostly it relates to bonus payments, and the union wants these to be calculated in not only a more transparent way, but they also want to make sure that there's some sort of assurance that workers are actually going to get their bonuses, particularly in the chips division, which the union counts chip workers as its biggest membership base. There are about 30,000 different staff in this particular union. So as we said, this strike now being expanded indefinitely, the risk that it impacts production. The union has been very clear that it does want to disrupt chip production. They're going to start by targeting a facility that produces 8-inch chips. They're then looking to go ahead and target high bandwidth memory production as well. HBM is really critical because this is a type of chip that's very, very essential to AI overall, AI technology, and where it's an intense competition with the likes of SK Hynix, a much smaller tech company in Seoul, but very much more dominate in that HBM space.
And of course, the longer the walkout goes on for, the more that's going to have an impact, and not just on Samsung, but on the broader sector. Technology reporter Annabelle Jewelers, thank you so much. Well, very important section coming up now. Before we go, we're going to talk football. Spain is heading to the Euro 2024 finals after a 2-1 victory over France with a wonder goal by 16-year-old Lamine Yamal, 16 years old, the youngest to score at the championship. The team will be up against either the Netherlands or England because it's going to be a late night for fans in the Middle East tonight. That semi kicks off at 8 p.m. London time. That is 11 p.m. in Dubai. Is football coming home? We will see. It is going to be a big match tonight. And of course, how can we forget England losing to penalties, losing to Italy on penalties back in 2020? Will they redeem themselves? Well, we'll find out the next couple of days. If I'm in a good mood tomorrow morning, you'll understand why. This was Horizons Middle East and Africa. I'm Joanna Versace in London. Stay with us now for Daybreak Europe. This is Bloomberg.